Good morning, students. This is Sandhya, Assistant Professor, Department of Commerce. In this section, we are going to see about the subject financial reporting. In that, we see meaning of financial reporting, uses of financial reporting, objectives of financial reporting, benefits of financial reporting, and limitations of financial reporting. And then followed by integrated reporting meaning and its benefit. Now go to the topic meaning of financial reporting. Financial reporting involves communication of financial information about an entity to various stakeholders. Stakeholders are the party that has an interest in a company and can either affect or be affected by the business. Investors, employees, customers, and suppliers are considered to be stakeholders. The reporting entity may be an individual, firm, company, or any other form of business enterprise. The uses of financial reports would include investors, shareholders, lenders, government agencies, etc. The reporting entity may be used for minimizing the information asymmetry. As insiders, that is, management owners, have better information about the financial performance and to know the health of the enterprise. Through financial reports, they share the information with the external stakeholders and thereby helping them in financial decision making. Now we move on to the next topic uses of financial reporting. Users use the financial statements in order to satisfy some of the information needs. The first type of user is suppliers of capital. The objectives of general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. They access the capacity and ability of the organization to pay interest and repay the principal using the financial information. Suppliers of capital include debt and equity to usually have a long term view about the enterprise. This group has a direct stake in a financial health of the organization. They use the financial information to access the return profile of the organization. They use financial information contained in financial statements, help them to judge the return they can expect from their investment as well as the risk they are exposed by investing or lending to the organization. The next type of user is credit rating agencies. The credit rating agencies facilitate raising of capital. For example, credit rating agencies also rely on the information contained in financial reports to form a view about the financial health of the organization. The next type of user is customers. Customers want the financial information, especially when they have long term contracts with the enterprise. This information is useful to take the decision continuous of the enterprise. It helps customers to judge the continuous of the enterprise. The next type of user is tax authorities. as business units are liable to pay tax on their taxable income. Financial information is used to ascertain the same. However, it must be noted that the taxable income is computed in accordance with the provision of applicable tax laws, and these provisions do differ from financial reporting principles. It forces companies to maintain separate accounting records for tax purposes. The next type of user is regulatory bodies. Regulatory bodies also use financial report for collating information. For example, the Reserve Bank of India oversees the banks as to profitability, maintenance of capital, credit concentration, asset liability mismatch, etc. Using key information derived from financial statement of banks. Likewise, Insurance Regulatory and Development Authority uses the information contained in financial statement of insurance company for various regulatory purposes. The next type of user is employees and trade unions. Employees and trade unions want the financial performance of the company to judge the soundness of the enterprise and that they are being properly rewarded. The information may also be used for wage negotiation by the trade unions. The next topic is objectives of financial reporting. Financial reporting primarily aims at meeting the informational needs of external stakeholders. The financial reports are used by the stakeholders for the following objectives. The first objectives of financial reporting is decision making. Financial reports are used by the investors and lenders to access the risk return profile of the organization. The information helps them to judge the return they can expect from their investment as well as the risk they are exposed to by investing or lending to the organization. They access the capacity and ability of the organization to pay interest and repay the principal using the financial information. Likewise, regulatory bodies and government bodies use financial information for macro level decision making. The next objective is improved corporate governance. Corporate governance is nothing but it is the structure of rules, practices, and process used to direct and manage a company. A company's board of directors is the primary force influencing corporate governance. Bad corporate governance can cast doubt on a company's operation and its ultimate profitability. Improved corporate governance in financial reporting is an integral part of managerial accountability and corporate governance. The shareholders using financial information can access managerial effectiveness in utilizing and safeguarding the resources to meet their expectation. The next objective is corporate sustainability. Financial reporting also helps in ensuring corporate sustainability by ensuring that the enterprise is creating long-term stakeholder value through the implementation of a business strategy that focus on the economic, social, environmental, cultural and ethical dimension of doing business. Now we move on to the benefits of financial reporting. The first benefit is improved decision making. With improved availability of financial information, the stakeholders can make informed decisions relating to allocation of resources. The investors and lenders use financial information to access the past performance and make projections about the future cash flows as well as the risk attached. Financial reporting is an important essential tool for investment decision and credit decision. The next benefit is improved market efficiency. Transparency is one of the precondition of an efficient financial market. Financial reporting meets the informational requirement of external stakeholders and thereby reduce information asymmetry. As a result, the security prices reflect all information about the company. The next benefit is improved public image. Financial reporting helps in improving the public image of the company. The external stakeholders are informed about the economic performance as well as the contribution made by the company towards social, environmental, cultural, and ethical dimensions. The next benefit is reduced cost of capital. Due to reduced volatility, improved public image, and transparency, the company can raise capital from the market with S and at a reduced cost. As the investor confidence in a company increases, the cost of capital to the company reduces. Next, now we move on to limitations of financial reporting. Though the financial reporting serves the need of various stakeholders, it does have certain limitations. The first limitation is general purpose reports. The financial reporting aims at meeting the information requirement of a large number of stakeholders. As such, they are at best general purpose reports and not customized to meet the requirements of a specific user. It is expected that the information contained therein would be useful to all potential users and they can analyze the information further to meet their requirements. The next limitation is frequency. The financial statements and various other reports are prepared annually. Like listed companies also publish quarterly results. As such, these reports are available only at specific intervals and not as and when they are needed. The next limitation is manipulations. The financial reports are required to be audited by independent auditor. However, there have been cases where management has manipulated these reports through window dressing. The financial reports are made to hide the real picture. The external stakeholders have no means to verify the authenticity of the information. We conclude that the financial reporting in simple terms, a financial report is critical for understanding how much money you have, where the money is coming from, and where your money needs to go. It is important for the management to make informed business decision based on facts of the company's financial health. Next, now move on to the integrated reporting. And integrated reporting is a concise communication about an organization's strategy, governance, performance, and prospectus. The primary purpose of an integrated reporting is to explain to providers of financial capital how an organization creates, preserves, or erodes value over time. From this, it is clear that the integrated reporting has a stakeholder orientation and focuses on the value creation process in the organization. It is both backward looking and forward looking. It not only summarizes the past performance but also provide information relating to value creation process over a short, medium and long term. An integrated report benefits all stakeholders interested in an organization's ability to create value over time, including employees, customers, suppliers, business partners, local communities, regulators, and policymakers. And understanding of the value creations would require understanding of the external environment, relationships between various stakeholders, and dependence on various resources. Therefore, the integrated reporting would cover these aspects as well. The integrated reporting highlights the following characteristics. Integrated reporting reveals the value creation process, including strategy and governance in an organization. The next characteristics is the orientation of integrated reporting is stakeholders, employees, customers, suppliers, business partners, local communities, regulators, and policy makers. The next point is integrated reporting explains value creation over time, that is short, medium, and long term. Integrated reporting is contextual. It considers the influence of the external environment on the value creation process of an organization. The last characteristic is it is both backward and forward looking, and it analyzes the past performance and the prospect of the organization. Next, now we move on to elements of integrated reporting. The first element of integrated reporting is organizational overview and external environment. It is used to identify the information that includes mission and vision, and a key quantifiable information such as the number of employees and the external environment affecting the organization. This section addresses the organization structure and the operation condition of the organization. It helps to know the external environmental that affecting the organization. The next element is governance. It helps the company to know the organizational structure, supports the ability of the organization to create value in the short, medium, and long term. The section links leadership, strategic decision, organization culture, remuneration, and incentives to the creation of organization value. It helps to know the support system of the organization. The next element is business model. It helps to know the information reported in the area includes business activities, inputs, outputs, features that can be enhanced, and information covered by other sections which are part of the business model. This section addresses the organization's business model. The next element is risk and opportunities. It helps to know the opportunities affecting the organization ability to create value and highlights the action the organization is taking in dealing with them. Reported information includes internal and external value, risk, probability of the risk happening, and this magnitude and specific steps the organization is taking to address the risk. The next element is strategy and resource allocation. The element entails the company's short, medium, and long term strategies, existing strategies, resource allocation plan, and the method It will use to measure it over overall performance. It can also use include the details about how all its activities are linked together and point out factors that differentiate it from its competitors. The next element of integrated reporting is performance. The companies should demonstrate a progress with the use of quantitative and qualitative information. They can also highlight the key performance indicators that combine to help the external environment of the organization. The next element is outlook. The companies lays down anticipated changes in the company's external environment and the manner in which the company plan to address the change. It also lays down the reason for predicting the said changes while ensuring a realistic evaluation of its competitive landscape, market positioning, and risk. Then the last element of integrated reporting is basis of presentation. The report includes a summary of the company's materiality determination process, a description of its reporting boundary, and the frameworks and methods used to quantify the presentation of the organization. Next, now we move on to the main. What are the main purpose of integrated reporting? The primary purpose of an integrated report is to explain to providers of financial capital how an organization create, preserves, or erodes value over time. What is an integrated reporting system? Founded on integrated thinking, an integrated report communicates how an organization's strategy, governance, performance, and prospectus in the context of its external environment create, preserve, or erode value in the short, medium, and long term. Now we move on to the six pillars of integrated reporting. The six capitals are financial, manufacture, intellectual, human, social, and relationship. By taking this into account, when reporting on performance, a company provides a fuller picture of the way in which it creates value. Now we move on to the benefits of integrated reporting. It helps to encouraging the organization fitting in an integrated way, and it helps to clear articulation of strategies and business model. The single report that is easy to access, clear, and concise, creating value for stakeholders through identification and measurement of non financial factors, linking of non financial performance more directly to the business. Better identification of risk and opportunities. And the last benefit is improved internal process leading to a better understanding of the business and improved decision making process. Limitations of integrated reporting. The main limitation of integrated reporting is it does not provide detailed information. Also, it includes non financial information due to which it is more time consuming to prepare. It requires high expertise for understanding this report because it is a concise report explaining the matter in summary. We conclude that an integrated report is a concise communication about how an organization's strategy, governance, performance, and prospectus lead to the creation of value over the short, medium, and long term. Thank you, students.